Devina, let me come to you. You've been the first, if I'm not wrong, 25 years back. You're the first global investor or global at that point in time. It was relevant back then. It is relevant now as well. How has the conversation shifted, or how has the conversation changed according to
Yeah, I mean, when I went global, that would be like in history books for a lot of people here. This was in the aftermath of what is now known as the Asian crisis, when the Asian tigers went through a crisis whereby between the currencies fell and the markets fell. So between the two, Taiwan was down 50%, Indonesia was down 90%, Thailand, South Korea, Philippines, between this 50 and 90 in just 1 year. And that was a wake-up call for me that this is the danger of putting all your eggs in one basket. And I had actually worked in Indonesia for a brief while to set up Citicorp security subsidiary. So it was like I could actually see it that, this is what can happen. And the other thing, of course, was I said, kab tak wahi Infosys, HDFC, Bajaj Auto, SBI karte rahenge. I want to look at more companies, more different markets. So in 1999, we were not just the first Indian, we were the first Asian members of the London Stock Exchange, other than the Japanese, and the next year of the US Broker Dealer Association. So I've been following global markets since 99, and not just US, Europe, even the bigger companies in China and Japan since then. And our research was covered by Forbes, Fortune, Business Week, all of that back then, Wall Street Journal. So, I mean, one was, of course, as I said, these were my motivations at that time, but the fact that you should not put all your eggs in one basket still holds. The other thing is that when I started my career, the dollar was 12 rupees. So if you're talking of long-term goals, saving for long-term goals which are 10, 20, 30 years hence, you cannot forget that the rupee depreciates. In the morning, I already gave you that statistic that India is only less than 3% of the world market cap. So there's no logical reason why 90 or 100% of your investment should be there. So those are the logical reasons. And if anything, now hard currency expenses have gone up, lot more of the children go abroad to study. People's children, settle abroad, and they say after retirement we'll spend 50% of the time there. So basically, hard currency expenses are going up, and this is not something I've started saying in the last 6 months or 1.5 years. This has been the theme of my song for very, very long. That you must have reasonable global investments, and not just in the US, because US and India are not the world. And so that you have to, really think very carefully about your long-term savings. Still, Indians, because many of us grew up at a time when you could not invest abroad, long after I started working, you could take out only $500 once in 3 years when going abroad. So, that mindset is still there. We do not look at it. Good 20 years, the liberalized remittance scheme has been there, which is actually a very generous scheme. You can send $250,000 per person per year. Family of 4 can send out $1 million a year, but we are still in that old mindset when gold used to be the only thing which gave you a hard currency hedge. I mean, our grandmothers were not wrong in buying gold, because at that time you could not buy any other foreign currency denominated asset, but now that is not the case. So you have to look at it, but don't look at it from a knee-jerk perspective that 1 year India has not done well, so therefore let me go and invest globally, and there's a good likelihood the next 1 year might well be much better for India. So it is not that. It has to be a well thought out asset allocation that you stick to. That is the way to look at it. And again, I'm repeating, US is not the world. The geopolitics, Kshitij, if you permit me, I mean, I have looked at 125 years of data from 1900 onwards on all the major geopolitical events. So this is the 2 world wars, the 2 Gulf wars, 9/11, US bombing Libya, Afghanistan, whatever. And the conclusion is very clear that do not react too much to geopolitics, because it all evens out. And this is exercise that we first did when the Russia-Ukraine tension was building up in 2022. And on the day the war broke out, on the day I had made a video saying the markets will forget about it in 6 months. Because, this was not a statistical exercise. I didn't find an exception. Every single case, the markets forget about it unless the country is directly in the conflict and is defeated. So, I mean, if you were Germany or Japan in the Second World War, those are the only kind of exceptions. Otherwise, the usual crisis in financial markets happen for other reasons, not geopolitics. So other than direct impact on commodity prices and that impact on a company's earnings, you should not spend too much time on geopolitics.
More than 2 decades now, what are the mistakes which one should avoid when they're doing global investing? One of the things which you already pointed out that avoid global geopolitical concerns, which anyways comes forth. So yeah, it happened, but don't react to it. Over to you on that.
Yes. So the other one, which I mentioned briefly in the first part, was that don't think that the US is the world, because the people think that all world stock markets always move in sync with US, with the US being the leader. But there have been long periods when the US underperformed. So as I said in the first panel, that one thing is certain about markets, that themes change, whether it is countries, asset classes, even investing styles. So US, for example, 2003 to 2000, about 7, 8, that was the period when US wasn't even coming off a high. It was already down after the tech crash. And still in those 4.5 years, it gave a return of only some 60% at a time when India went up 6 times. The emerging market index went up about 3.5, 4 times. Brazil went up 10 times. And see, in anything that happens in the market, the narratives follow. So at that time, it was though the US is over as a country. That is when BRICS acronym was coined, that now the world has moved on from the US and the leadership moves to the BRICS. Then when the US started outperforming again, those stories were forgotten. So, that is the whole point, that markets always change. Often, if you look at the global markets, the top 40, 45 markets, very often you will find that the bottom 5 markets, at least a couple of them will be in the top 5 in the next year. Even countries with real problems like, in the recent 5-6 years, there have been Russia, Turkey, Sri Lanka, who went from the bottom to the top. And of course, 2022, and now everybody has forgotten that in 2021 was the last time we had a global fund boom in India, when a lot of NASDAQ ETFs and funds of funds were launched. And 2022, NASDAQ was almost the worst performing index in the world. It was 40 out of 42 countries. And people came to me and said, I'm down 40%, should I exit? I said, don't compound a bad buy with a bad sell. Because a major index down 40% is almost never a sell. A stock down 80% can also be a sell. That's the thing, that be in a truly globally diversified portfolio, which is of all countries, all asset classes. The other thing is choose your fund manager carefully, because unfortunately, and I wrote about it and people said you're going to get lynched by your community for this. Too much of the asset management industry is an asset gathering industry. They are not offering you a product because they think that's the theme that will do well. Too often they're offering you a product because they think this is when I can get money from investors on this theme. And this is what is happening with a lot of Gift City product. Very unfortunate. I just collated the data, and most Gift City products have done very, very badly for the last 6 months and 1 year. Nobody is even close to the benchmarks, because global investing is extremely complex. Global companies are complex, much more complex than India. The list itself changes. In the early 2000s, when I started doing the US market, tech majors meant companies like IBM, Dell. Cisco was once the most highest market cap company in the world. Now the whole list has changed. Barring Microsoft, which was a major then and is a major now, the whole list has changed. Not that those companies have gone out of business. So, to understand that, you can't do that with 2 analysts, and just because you can form a Gift City product doesn't mean you know how to manage global money. So be very careful on who you go with that. So those would be my 2 things, that don't think US is the world, and be very careful on how you do the global investing. One framework I would just like to add on this active versus passive. Most people think passive is lower risk. Actually, to my mind, the only real value an active fund manager adds, most of them, I would say only, but mostly, is risk management. That if the market falls 30%, do you fall 30% or less? Because in an index fund, you will fall 30%. Because in a runaway bull market, it is almost impossible to generate alpha by managing it actively when every riffraff stock is going up. It is when the markets go down, that really, and that's what actually the data also shows, that the best performing mutual funds are the ones that outperform during downturns. There was one fund, it was a ET Money story, I think, where where the best performing funds were, as I said, which outperformed during downturn. There was a fund which outperformed in 90% plus of the up moves, but was among the bottom 5 funds because it fell more when the markets fell.
We have a few minutes left, and I think I'll open it for the audience in case anyone has any question. Okay, good. We are seeing some few questions. Okay, back then we have one gentleman back there.
So I'm Ayush Agarwal from Power Exchange India Limited. My question to the panel is, we are talking about global investing. I want to know what is the most efficient way of global investing. Because while I understand that the LRS limit is very generous, but there are a lot of bottlenecks, right? The $7 billion limit on fund houses was breached like 3 years ago. And like Devina mentioned, gift city funds are not doing too well. Now the third method which remains is to open a fund international broker account. So just 2 questions. What is the most efficient way? And second, with this rupee depreciating, do you see RBI shifting this $7 billion limit up because it has not happened for 3 years now?
Very difficult to say what RBI will do. But I mean, since this is a cause for me and has been for many years that Indians should invest more overseas, I've done what I can, which is that have a product which invests across all geographies and all assets and starts at $10,000, which used to be 7.5 lakh rupees not very long back. Now it is 9.5. Of course, there's a little more tax efficient product at a higher starting, but this is what we could do. And yeah, I mean, RBI changing that limit has not happened, and it's anybody's guess whether when that would happen. And given where we are on BOP and exchange rate, I doubt whether it's coming in a hurry.
Else? So we have one gentleman here.
Hi, I'm Sandesh from ISI Global Market Intelligence. My question is, if you look at the local markets here, so there is a great support from the retail investors. So SIP worth 32,000 crore has been month over month been supported by retail investors. But if you look at the capital flows, there has been a great divergence, especially flows which used to come from GEM as well as few large foreign portfolio investors have been shrinking in last 18 to 20 months. The local fund managers are doing a great job with this kind of support from the retail investors. We're seeing sizable investments coming out of our own country, which is good because we believe in our very own India story. My question is, in order to attract capital flows once again, what is it that regulators can do? LTCG, we've been often hearing, is a deterrent, especially to FPIs. And most of the global markets do not have such frameworks to penalize foreign investors. Do we need to rethink, go back to the drawing board, take some reforms and measures which will eventually attract capital back into the country? So what could be those reforms?
Right, some 2-3 questions.
Can I just take
Sure.
that? I'll at least start with that. So first of all, see, in this framework, what we think is that when FIIs start buying, the market goes up. When FIIs start selling, the market goes down. But that's a leap of logic. Actual data doesn't support it. In the morning, we spoke about this period. Remember 1994 to 2003 when the market's net displacement was 0. 1994 is when the foreign portfolio investors started investing into India. I started the business because the market was open to foreign institutions. So I remember this whole story very well. So you would have thought this is a new slew of money that's going to come, and billions did come. There was no Indian mutual fund to speak of. And standing in 1993, you would have said this would take the market to new heights. And yet that was the only 9-year period in which the market gave 0 returns. So, this is a myth. We might want to attract foreign portfolio investment from a balance of payment and exchange rate perspective, but it's a myth that they drive the market. They didn't drive it even when we didn't have these domestic flows. That's the whole point.
On that note, I guess, thank you so much for your time, ladies and gentlemen. And thank you, audience. You've been a fabulous audience with some smart picking of our panel here. So a big round of applause to everyone, guys. Thank you so much.